This is Richard Flax at Moneyfarm with our outlook on global markets and some changes that we've made to portfolios. When we think about the global environment, we really start with the economic recovery. We continue to think that 2021 will be a good year in terms of global growth, after obviously a very challenging 2020. And the first quarter data seems to support that, with improvements on the employment side and also improving data from both manufacturing and the services sector. Much of this obviously depends on progress on the healthcare side. The picture here is a bit more uneven. The vaccine rollout is mixed. We've seen real progress in some places and perhaps a slower rollout elsewhere. And we continue to see mutations of the virus emerge around the world. So the number of cases has been rising. The number of fatalities sadly continues to rise as well. But we continue to think that with the global commitment on this front, we will see significant improvements, and that will allow the global economy to begin to normalize at least somewhat, even if perhaps it doesn't quite look like the world we knew back in 2019. On the inflation side, we've begun to see inflation pick up a little bit, particularly in the US, but we continue to think that this will be relatively short-lived. Importantly, we think that central banks won't feel the need to act in the short term in response to rising inflation. And we think that central banks like the Federal Reserve or the Bank of England will continue to really wait to see the economic recovery bed down and really begin to see some signs of pricing power before thinking about acting in terms of removing some of the stimulus that we've seen them introduce over the last 9 to 12 months. So what does this mean for markets and portfolios? In general, it makes us cautiously optimistic about risky assets. And in some of our higher risk portfolios, we've added to our equity positions. We've done so partly through emerging markets, where we continue to think that they will benefit from the overall global recovery. And we've added some UK mid-cap exposure. Generally speaking, we don't have a lot of UK equity exposure. We've generally preferred to be globally diversified. But we do think that the UK mid-cap space, where which is perhaps a bit more exposed to the domestic economy, could benefit in an environment in which the UK economy really begins to re-accelerate. So it's a fairly optimistic view about the outlook for global growth and a little bit more for UK growth as well. In the mid-cap, in the more mid-range portfolios, we've added some exposure to Chinese government bonds. We've been looking around obviously for opportunities to increase yield, given how low global interest rates are, and also look for assets that perhaps could give us some diversification benefits. And we think that Chinese government bonds can perform both of those roles. Obviously, there are a range of risks that come with that, and so we've sized those positions relatively small to capture some of the yield pickup that we can get in terms of generating income for the portfolio, but without making it too big a part of these portfolios and managing the risk appropriately. Thank you very much for your time, and look forward to speaking to you again soon.